The information and opinions expressed in this show should be considered as entertainment and for educational purposes only. We're here to inform, enlighten, and make you laugh, but we're not giving financial advice. Any information in this episode should not be relied upon while making investment decisions. If you're looking for financial advice, please consult with a professional financial advisor. The hosts and guests may or may not hold positions in the securities we discuss. Welcome to today's episode of Stock Up, a podcast about the finance markets and stocks. We're excited to welcome back Barry Schwartz, President and Chief Investment Officer at Baskin Wealth Management, where he's led the research and market analysis team for over 24 years. He's also hosting the excellent podcast Long-Term Investing. Barry joins us today to share his latest insights on the markets and some excellent companies. Let's dive in. Welcome back, Barry.
Thanks for having me, and congrats, guys, on the growth of your podcast. And I'd like to say that I've helped in a little way, and I hope some of your listeners will also check out the Long-Term Investing podcast with Baskin Wealth. I think they'll really enjoy the conversations that Ernest Wong, our head of research, and I have. But this is your podcast, and you've had some great guests on, so I'm so thrilled and flattered to be invited back for a second time. I guess I did something right.
Yeah, you absolutely did. And before we dive deeper into some of your biggest holdings, in your podcast, you've emphasized simplicity over complexity in investing. So, what are the biggest mistakes investors make in portfolio construction, and how can they adopt a disciplined buy and hold approach like you guys do?
Well, there's no fluff here, eh? Right into the meaty questions.
Of
How's your
course.
summer? Or what are you up to? Or Barry, that's a great sweatshirt that you're wearing with the Baskin logo. Yeah, so down to business. I'm happy to get down to business. Listen, everybody in investing is playing a different game, right? So that's the most important thing as an investor that you have to realize. Figure out what type of investor you are. Do you like to trade? Do you like momentum? Do you like dividends? Are you a cautious investor? Are you a growth at reasonable price investor? Are you a long-term investor? Are you in it for the short term? Right? So it's just like religion. There's many paths to investing. There's many paths to enlightenment, but you have to figure out the one that works for you and your temperament. So, and of course, it's possible that your temperament as an individual investor could be different than what you do for clients. Luckily, at Baskin, what we do is the same that I would do for my own portfolio. I hate selling. I like to own the best businesses in the world. I like to let the managers do the work for me. There's nothing better than investing, and I think we probably talked about this at the last time I was on. No one calls me in the middle of the night telling me that the toilets aren't flushing, and I have to go to my apartment that I own and rent out and fix it. No investment calls me up and says, "Hey, you got to put more money in, or you can't get your money out for 5 or 10 years." Right? I love investing in public equities. I can't believe that people will choose private equity and all these alternatives over investing in the greatest businesses in the world. But that's their choice. So when we talk about portfolio construction, when we talk about how Baskin invests, it's important to hit home that we're long-term investors. I follow the words of Warren Buffett and Peter Lynch. Own good businesses. If they're doing well, leave them alone. And I think by being the president and the largest shareholder at Baskin Wealth, it's made me a better investor as well, because I understand I own a business, and I understand the complexities of owning a business, what goes into valuation, cash flows, reinvestment of those cash flows at our shop. These are the things that help us think, and I think improves our knowledge as investors for others. So I'm not sure I answered anything about your question. So maybe let's drill down on exactly what you asked about. So as a long-term investor, you have to keep it simple. You can't survive by using a galaxy brain approach when it comes to long-term investing. Oh my God, Trump's putting on tariffs. We should do this right now. Oh my God, the tariffs aren't going through. Now we should do this. Oh, wait a minute, the tariffs are going through. So you just lose your mind. And yesterday I was interviewed by Canadian media about the CPI number in the United States. What happens if it comes in hot, Barry? What happens if it comes in below expectations or cool? I said none of that matters to long-term investing. Absolutely, it matters to the day-to-day market movements. And if you're a short-term trader, absolutely it matters. But to long-term investors, it's ridiculous. You should spend zero time thinking about macro and 110% of your time thinking about owning businesses for the long term. So as for portfolio construction, once again, there's no right answer. Obviously, if we knew the future, I would overweight stock A and underweight stock B. But hello, I don't. Neither do you. So what I have to do is be very, very careful with our clients' money. Our clients come to us, and they've chosen us because they're looking for safety, diversification, protection, capital preservation. And so when a client invests with us, I don't care if they give me $1 million, $10 million, or $200,000. We view their portfolio and that money that they allowed us to invest as everything that they have in the world. And so when you take that approach, you do things differently. And that means more diversification than maybe some other shops. That means position sizing is more equal weighted than necessarily trying to put 30% of your money in your highest conviction idea. It means more compliance and in terms of having a process to deal with overweight positions. And having to deal with industry allocations and geographic allocations. So I hope I've set the table for you in the sense of how to think about things from the buy side of investing, managing money for private clients. It's completely different than what you may do for your own portfolio. But we're dealing with, for the most part, clients who are great at what they do, in their own lives, but scared of the markets. Not they don't have the time or the interest to pay attention. But when I speak to clients, all of them want the same thing: make me money and don't lose it. And so I take that to heart.
And what I've always liked about you, Barry, especially when it comes to market volatility, is that you look at the big picture. I remember last year when I asked you about the concentration risks, and I really loved the tweet you made about um, some of the experts in the mainstream media calling out the top 10 names in the S&P 500, but they are actually the ones that is expected to grow much faster than the overall market, so they deserve the premium and the the hype. Am I right?
Absolutely. Do your own research, do your own due diligence. Never make investments based on a chart that someone puts up on Twitter or the headline of the day or the narrative of the day. And I'm sure we can get into that more discussion more specifically. But, uh, you know, I always remain skeptical of Wall Street, Bay Street. Does Norway have a street that they call? But I'm skeptical because they're in the business of selling. Okay, Jamie Dimon. I think Bitcoin is crap, garbage, and then 5 minutes later, he's got a Bitcoin fund, right? So you have to be careful of the motivations. So this goes back to, everything in investing can just go back to a few sentences by Warren Buffett or Charlie Munger. Show me the incentives, I'll show you the outcome. I'm not in the moving business. I'm in the storage business. I collect. I collect investments. And so we have to think differently. I don't care about industry concentration and oh boy, it's the biggest it's ever been. Okay, well, that's what happens when companies do very, very well. And it could be a harbinger of bad things to come, or it could be completely meaningless. And so, once again, we focus on buying the companies we want to buy. I'm not owned by anybody, so there's no conflicts of interest. There's no private equity firm or a bank telling us what we must do or not do. And so I just love the freedom of being an independent wealth management firm and being able to make judgments and decisions based on what we think are actionable ideas, and instead of being sold things. I don't accept any calls from institutional salespeople. I don't go to many conferences. I don't care about the pitch of the day. That stuff is meaningless because, like I said, those people are playing different games than I am. I, when I buy something, I want to hold it forever. And if you want to hold it forever, what matters is the growth of earnings and free cash flow per share, the allocation of those cash flows, the management who has skin in the game. These are the most important things that we think about as investors. So once again, not really sure I answered much of your question, but once you get me talking about stocks, I don't stop.
Yeah, this is pure gold, Barry. This is excellent. So, if you could touch a little bit on the politics side, been a lot of noise after Mr. Trump became president with trade policies. So, how do you think about tariffs and the impact they have on portfolios?
I famously said in many media interviews that the tariffs are going to be a nothing burger. I said it was just going to be a negotiating tactic by Trump, and some of it, you have to understand what the U.S. government is trying to do, and what Trump's platform is. The tariffs could be good, they could be bad, they could be a non-event. Right? It's everybody thinks that because something new is happening, it's got to be necessarily bad and evil, and it's going to be disruptive to the market. And no question, markets hate uncertainty. So when that tariff stuff came out, I was actually being interviewed on Canadian media the day that Trump announced the tariffs, Liberation Day, waiting after hours for Trump. He made a speech, but the speech went on for so long that barely had time to comment on the media. But when I saw those numbers where he said, I'm doing 80% here, 40%, I knew it was all, pardon the French, BS. I knew it was just a let's start at the highest, craziest number and work our way down. Once we saw that China was interested in negotiating a deal, we knew that the rest of the tariffs are not really that impactful. The other thing to think about, of course, is who's going to be paying for the tariffs? You look at General Motors. They may eat some steel costs. Maybe the consumer will eat some pricing. Maybe the exporter will eat some pricing. But the companies that are significantly impacted by tariffs are not relevant in the S&P 500 for market cap. The ones that were, like Apple or Nvidia, and knew 100% that there's no way they're going to be making iPhones in the United States. You had to just say this is complete BS, and that more often than not, the world is not going to change very much. And so that's the approach we like to take. We like to take that, yeah, crazy stuff does happen, but most likely it's not very damaging, and we'll recover. And there's always ways to offset things, right? So maybe the tariffs hurt General Motors, but maybe it helps. I don't know. Maybe it helps Google. Who knows, right? And so, you really have to read a lot, study a lot, and have conviction in your process.
So before we go away from the tariff narratives, I'm just wondering, because a lot of our listeners, and me included, are invested in Canadian companies. What is the narrative in the Canadian media when it comes to these tariffs, especially with ongoing US, Canada, Mexico trade tensions?
They're obviously very worried, but when you look at the Canadian stock market, the Toronto Stock Exchange, it's at an all-time high, right? So, what's going on? And many European markets are at all-time highs. Interesting to note that a lot of it has nothing to do with corporate earnings growth. It's multiple expansion, right? So the multiples have expanded tremendously for non-North American equities, but it's really just money flowing out of U.S. stocks into European stocks without actually earnings growth. The earnings growth is coming from, really the top U.S. technology names and a few others, as we talked about. I completely forgot what you asked there.
You answered the question.
Yeah. So, what do Canadians think? Canadians, well, obviously the media is they love to talk about the tariffs and what we're doing and how bad it's going to be. And to be quite frank with you, the economic numbers in Canada have not been terrific. We had job losses in the most recent jobs number report, so that's not great. Inflation is still sticky, but Canada is a dynamic economy now. No question, a lot of commodities and cyclical businesses. But hello, look at the largest company now in Toronto. It's Shopify. And then you have the banks, and you have utilities, you have pipelines and railroads. Some of these may not be so impacted by tariffs. And of course, given the strong run in gold, that's really helped the Toronto stock market. And the Toronto stock market has, I think, about 10 to 15% allocation to copper and gold and those commodities that have done well. So it's a weird mix, and I don't care so much about what people are saying about the economy. I care what companies are saying, and the makeup of the indices in each country. That's more important for us to focus on.
Yeah, that's excellent. So if we pivot over to some of the best companies in the history of mankind, if we were to dissect, what are the most important common characteristics in the best of companies in your view?
We've never seen companies like we have today. Never. This is and this is not talked about enough. The top 10 S&P 500 and a few European businesses and companies around the world. We've never seen global platforms with the distribution reach ever. We've never seen a company that has billions and billions of potential customers where they can sell more services and more products, and these customers are completely addicted. Apple, Amazon, Meta, Tesla, like it's just unbelievable. So it's kind of silly to compare the companies of today to any other period, because it makes no sense in our opinion. If you look at the top companies, the largest companies in the world 25 years ago, IBM, Exxon, Chevron, like it was all commodity-based companies. GE, which maybe people thought was a good company, turned out to be a complete gong show over there. But we never had companies that have recurring revenue, this much free cash flow, this much high margins, high returns on invested capital. And then, of course, this tailwind to possibly the biggest game-changing technology the world has ever seen, which is AI. So, I hate when people say, oh, the market's 23 times earnings. That's expensive based on history. Okay. Show me companies in history that were as good as the companies today. So that's my argument there. It's no different than that concentration where people say 40% of the S&P is in these tech companies. Well, 34% they make up 34% of the profits, and as I tweeted out, have much faster growth, and they're going to compound cash flows at a very high rate, we believe.
Yeah, it's pretty insane. So they really, I mean, like when you look back in history and look at the businesses as you mentioned, like just massive businesses, but they never really solved this scalability issue. Like they couldn't reach the people, and obviously, like the last 100 years, we've grown from what 3 billion to 8 billion. So that's a lot of more
Yes,
potential
a lot more
customers. But
people. Yeah.
yeah, but you still have a way to reach them.
And obviously, what's happened over the last number of years is you've had growing wealth in these countries, right? Poland, who would have thought, right? Number one performing stock market. I remember when I traveled to Europe 30 years ago, backpacking with friends. You never saw an Asian person. You never saw Eastern Europeans traveling throughout Europe and Italy. You didn't see it. Now when you go, there's rich people from everywhere, and they're traveling, and it's so exciting and so unbelievable how the world is shrinking, and everybody's on their iPhones. Everybody wants Wi-Fi access. You just have to take a look around, get out of the goddamn office, and go see the world and go see what people are actually spending money on. So that's there's absolutely no comparison the companies today that dominate the index versus, in our opinion, versus the companies that did in the past. You can also say, okay, Barry, what about the Nifty 50? That was a time when valuations of some of the hot growth and glamour stocks got up to 80 or 90 times earnings. Yeah, that was a crazy time, and there were some really good businesses in there, but still, you pointed it out directly. They don't have the global reach, the global distribution, and the types of products that keep people completely addicted.
I've seen a lot of people are comparing the AI narrative with the railroads back in the
Yeah,
days, and that
yeah.
was also the scalability was unlimited. I'm paraphrasing, and they were free cash flow machines. And so, is there some kind of similarity there, or?
Not at all. Not at all. And I think people are making a very poor analogy when comparing railroads and the fiber build out and the dot com bust to today. Uh, Quite simply, the demand for data is exploding. Like, it's just unbelievable. This is not a railroad that goes from one place to another and stops. This is data that is compounding at very fast rates that needs that needs a home on the cloud, that needs improvement, that needs AI to scale. So we've never seen a new paradigm like this where there's just so much demand and the technology is not there to meet the demand yet. Everybody wants to use more AI. People, businesses, everybody wants to improve their life, their productivity, have more free time to do better work, have an assistant that will do things for them. I think it just comes down to a very simple question. Do you think in the future we'll be using more AI, having more robots, more autonomous vehicles, playing better video games and better watching better shows on Netflix and more interactive stuff, or do you think we're going to be using less? I can confidently say we're going to be using a lot more, and as a result, this is nowhere near the railroad. These companies are already proving that these investments in AI are delivering and bearing fruit. You saw Meta saying, "Well, we're getting more engagement." Hello, isn't that what you want? You saw, you're seeing it in the profits of these companies. And so a year ago, the market was punishing these companies for the huge capexes. Now they were like, "Give us more capex. This is a once in a lifetime opportunity." So, but in case I'm wrong, okay, let's say we're wrong about AI, and it just becomes garbage, and people try and vibe code new software and it doesn't work and whatever. You still have the Magnificent Seven, a lot of them that have core businesses that will be fine if AI never materializes as a big driver of profits, right? So, okay, let's say AI turns out to be crap and gets worse going forward. Well, people are still going to Google search. People are still going to use Meta and Facebook. People are still going to pay for Netflix. People are still going to want their Apple iPhones. So I think if you're skeptical about AI, which you always should be because there's a lot of pre-revenue companies trading at crazy valuations, stick with the profitable companies that already have amazing core businesses that are generating an enormous amount of free cash flow anyways. I've been rambling here, but the one final thing I want to say is, people were complaining about the Googles and the Metas. That you're never going to get that free cash flow, and they're never going to give it back to you. Well, they're starting to give it back to you in a big bad way. They're making share buybacks and paying dividends, even with these massive capital expenditures. What more do you want?
Yeah, well said, well said. So how do you play this, Barry? Like,
What?
which industries or firms do you see as a not undervalued? Nothing is undervalued, but as a fair play on the AI narrative.
Well, we talked about this last time on your podcast. Is our approach is very simple. We're looking to own companies that can produce double digit growth in earnings and free cash flow per share over a 5-year period. Sometimes, of course, companies may be in a heavy expenditure, so that their free cash flow might be depressed. That's okay. I want to invest in companies that can have gigantic opportunities, right? I can buy a real estate investment trust. There's no gigantic opportunities there. Maybe I want to own a company that just doesn't go from undervalued to fairly valued. I want to own a company that's fairly valued or expensive that has unbelievable growth opportunities. So I think the way to look at it is to stick with the guys who have the distribution and the captive customers, the Amazons, the Metas of the world, the Googles, the Microsofts, the Apples, the Netflixes, the Oracles. Broadcom, why do you need to go anywhere else? The customers trust them. They use their products, and they're the only ones that have the cash flow to compete as well. Will it turn out to be a world where there's only 3 or 4 companies at the end of the day in 20, 30 years from now? Maybe. I mean, we have to be prepared for more industry concentration. These companies are going after gigantic markets, not just AI, but finance and healthcare. People are talking about how they're using AI to research new drugs, new medical technologies. These are huge. So the potential is unlimited. The demand is unlimited. The demand is going to grow, in our opinions, at a very high rate. There will be something that happens that will lead to some kind of pullback or crash, whether it's another DeepSeek moment, whether it's some kind of macro event or government event or political event. Who knows? But I still go back to the original thinking. Are we going to be using more AI or less AI in the future? And so and the better the technology, the better the scaling, and the better the outcomes. So this is going back to your original question, not at all comparison to railroads or fiber build out or .com.
That's a great answer because you've actually chosen the winners already. Why are you have to probe in the market for new companies? But a lot of our listeners and retail investors want to make some huge bets because they want to get rich quickly, and
Yeah.
it's tough to predict who will come out on top in the AI race. Many big players are raking in huge profits, as you mentioned, but we can all agree AI is a game changer that will shake up the tech sector. Wouldn't it be wiser for retail investors to focus on companies in industries less vulnerable for AI disruption, like the traditional stalwarts like Peter Lynch loves, for instance, Coca-Cola, Caterpillar, Cintas? What are your thoughts on this type of strategy?
Well, there's a reason that some of those companies that you listed trade at high valuations, right? Because as we remember Warren Buffett said, in 20 years people will still be chewing gum. Well, we don't know if people have teeth in 20 years, so you just don't know what the future will bring. But I think it's a fairly safe bet to say the elevators, the utilities, the uniforms, the Coca-Colas of the world, those durable businesses, the garbage pickup are probably going to be big winners in the age of AI. Why? Because the demand for their products will still continue. But they'll probably be able to, as market leaders, be able to use AI to reduce their costs and improve profit margins at the expense of their competitors because they'll be able to spend more money, and they'll, they already have the market share. So, there's so many opportunities. We look in our portfolio and we want to own companies like Waste Connections that we think will really benefit from the next iteration of technology. Waste Connections, as you know, operates waste hauling, owns some landfills across North America. Maybe there'll be autonomous garbage trucks. Maybe there'll be a robot that picks up. It's such a dangerous industry. People get hurt all the time. And turnover of employees, the biggest cost base. So I would urge your listeners to take a look at companies that could be radically changed in the future by adopting AI as well as autonomous and and robotics to improve their operations, but at the expense of its customers, right? Warren Buffett said if everybody benefits, then nobody benefits, only the customers benefit. But so you want to own companies that have duopolies, oligopolies, where the big guys benefit at the expense of the little who can't afford to spend money on the autonomous vehicles or, iterate the new technologies. So there's lots of ways to play it. I'm sure you could do well owning a portfolio of non-AI companies that would benefit from AI technology that could do better than owning the Microsofts and the Googles of the world. But just you got to have, in our opinion, you got to have a diversified portfolio of some AI winners, some AI disruptors, some companies that will benefit from AI. And you also have to say, well, maybe AI won't be as good as we think, and maybe some companies like the software names have been beaten up way too much, and maybe people thinking about them in a wrong way. No one knows when the disruption is going to happen. If they're all disrupted in 1 year, yeah, you should sell your Adobe and your Autodesk. But if you think that disruption is going to be 10 to 15 years from now, those are probably screaming buys. So a lot of ways to think about, investing in AI. It's not just buying Nvidia.
Some great pointers there, and uh, we love compounding machines and quality stocks. I hate when you have the media trying to um, make two different groups or type of investors. Like you're a dividend seeking investor, and you're a growth investor, and so on. I like the quality stocks, and they can be both. And you've noted that high valuations in the US market mean means future returns will rely on earnings growth, not multiple expansions. How do you identify? You mentioned that you wanted to own the companies with double-digit earnings growth in this environment, and do you have any new ones on the radar that you can talk about, or is this the positions you already own?
Well, I'm not going to talk about names that we're researching because uh, you know uh, we're still doing the work on them and may or may not buy them. So I don't want to talk about that, but I'm happy to talk about any stock that is on our 13F or client's own. We haven't been that active, guys, this year in investing. We only made one trade. We bought shares of Taiwan Semi. That was the only big investment that we've made this year. Earlier in 2024, we were much more active. We bought shares of MSCI, we bought shares of TransDigm, we bought shares of Couche-Tard. That hasn't worked out so well yet. And we also bought shares of Meta. We repurchased shares of Meta in 2024. So quite an active year in 2024. 2025 has been calmer. That's because of the volatility in the market. Sure, I can sell stock A, but stock B has also gone down as much as stock A, so it doesn't really get us anywhere. I'm looking for more calmer markets to take advantage of individual opportunities. Stock misses earnings, that's a buy. So I'll share one that at least has caught our eye, and that's FICO. I think that's probably caught a lot of quality investors who don't own the stock. That given the price drop, kind of reminiscent of what happened to MSCI shares earlier in 2024 when it missed earnings. Although this FICO is not about missing earnings, it's about its business model being disrupted. So it may deserve a lower multiple. MSCI is really just a bad sales quarter. So those are the things that are very important. Obviously, you have to recognize, is it a bad sales or a cyclical thing, or is it structural, or is it going to be forever changed? But that's one that we've been spending time on recently. Haven't made any purchases of it. We have to really understand if the business is forever changed or is it very attractive, because it now has come down to a much more attractive valuation. So our research process is very simple. We study all the best investors. We have a list of about 300 companies that we would like to do more research on or follow. Some of them we've done research on, some of them we used to own, and we're waiting for opportunities. And some companies we like more than others, and sometimes they fall to a very attractive level. Then we have to figure out if we want to sell something to buy something and how we're going to do that, take into account taxes. And so there's so many different ways. But answering your questions about companies with our research process, obviously we're looking for companies that have growth, companies that have organic and top line growth that is faster than the overall market, companies that generate higher free cash flows than the overall market, companies that are trading at attractive valuations where we can see growth coming. And here's what we do. We don't say, I'm buying this at 35 times earnings, and if it falls to 20 times earnings in 5 years, I'll still make money. I don't care about that. That's just nonsense. No one knows what valuations of a stock is going to be in 5 years. I think people are taking that margin of safety thing a little too literal. What I want to do is just say, I don't care what the multiple is going to be in 5 years. I care what the growth rate is going to be in 5 years. And I think if the company grows at double-digit rates over the next 5 years, you're going to make money on that stock. It's very hard not to. And sometimes multiples expand. Costco used to trade at 35 times earnings. Now it's 50 times earnings. And it may stay at 50 times earnings for a long time, may go to 60 times earnings. Who the hell knows? But I see a lot of people do. I pay 25 times earnings. And if it falls to 15 times earnings in 15 years, I still have a margin of safety because of the growth. I think that's overthinking, a little bit analysis paralysis. I would rather just say, here's Costco. It's trading at a reasonable valuation. If they do A, B, C, and D, I think they can grow their earnings per share at double digits over the next 5 years, and I see a long runway of growth. Buy the stock. It's trading at a reasonable valuation, and that's the approach that we take more often than not.
Yeah, that's excellent. Well, we were talking about just looking into FICO because that's also a stock that some of our members are very interested in, or have
Mm-hmm.
this drop has caught many eyes. So how what's your first impression? By the looks of it, the analysts expect like something around 20-22% EPS growth the next 2-3 years.
Pretty
That
phenomenal,
doesn't
right?
sound so bad. Yeah, yeah.
How many mature businesses that have been around for that long can still grow at those rates? Okay, so we all know that the market downgrades or lowers multiples on growth deceleration, right? And so FICO had a number of great years with new competition and potential regulatory. The impact to its growth is really unknown right now. You rely on a lot of things happening, all right? Are the competitors have a better product? Are they going to be able to make traction with the end users, even if it's a lower price? Is it going to screw up? Is it going to make mistakes? The cost of running a FICO score is so cheap, and the companies that use it already like it, right? And it hasn't led them astray. So it's potential that the competitors will gain more market share or not, and so that's the risk you have to take. But if you can see some other tailwinds to it, right? Maybe the interest rates come down, so the mortgage market it picks up, so there's more volume, and that offsets the market share loss. Meanwhile, this company is just printing cash. Who knows what they're going to buy? Who knows what other areas they're going to get into? Yes, and I love the fact that FICO, for example, has strong insider ownership. I think the CEO owns something like $300 million worth of stock. That's no joke. Show me that many CEOs that own that much of a stock. So these are the things we like to think about. But FICO for us it's not like it's an automatic buy like an MSCI where we were following it for a long time and the valuation finally came back to a level that we thought was attractive. FICO it's possible that its whole business is messed up. So you have to get a good sense of that before you make a decision whether to buy it or sell it. Because I'm not buying it to buy it at 1,300 and to sell it at 1,500. I'm buying it because I want to double my double the shares over a five-year period, hopefully. And so that's where we're at in terms of looking for a new name. Hopefully that's helpful.
You mentioned Costco's valuation, and we all have talked about it on our podcast, other guests as well. Costco is by far one of the best companies in the world, and Costco's membership model and 90% retention rates have made it a standout, but the valuation is quite extreme and are among the highest in retail. Uh, what prevents you from selling on when you have reached a kind of a peak on valuation?
Why would I sell a company where I can reasonably see them opening 30 to 40 stores a year for the next 20 to 30 years? Why would I do that? Where they will add more customers, add more services and products, and potentially still grow their earnings at a double-digit rate. Is it a one that is our most attractive idea at 55 times earnings? No, of course not. But there's a very few businesses. Let's not talk about like some of these new growth names like Palantir or whatever. Like this is an established company, for example. That there's very few established companies that are trading at these high multiples, right? There's Hermes, there's Ferrari, there's Costco. Chipotle was trading at that level, and then the growth is not there. So you have to deconstruct where this multiple is coming from. Why are people paying so much for Costco? Right. Well, you already said it. It's the great one of the greatest businesses in the world, and one where people can see long-term potential to be better, way better than it is today. So that's the story about Costco. A durable business which has growing free cash flows and growing earnings that you reasonably can expect it to be bigger and better in 10, 20, 30 years. You could argue could trade at 100 times earnings. Why should like who's the person on Twitter that gets to decide what multiple should be at? That's yeah, that doesn't compute with me. I mean, how many people have I seen tweet out over the years? I'm not buying that stock; it's too expensive, and then it doubles or triples, or we've all made that stupid mistake. So, I know you want to talk about like what characteristics make up a great quality business. I wish there was like an easy answer, but some of it is just like you got to go by the qualitative more than the quantitative. And the story on Costco is just so excellent. I'll tell you a quick anecdote. My parents have started driving 10 minutes further to go to the bigger Costco instead of the one closer to them. They'd rather inconvenience themselves 10 minutes because the bigger Costco has more selection and has the product that they want. More specifically, my parents love sushi, and they discontinued selling sushi at Costco in Toronto that they go to. So now they're going to drive an extra 10 minutes, and they don't care because they love it. And so I think you got, when you have a company like that, multiples are going to change. It's going to go to 30, it's going to go 50, it's going to go 60, going to go 20, who knows? But here's the thing. If you're waiting for the perfect opportunity to buy it, good luck to you. You might not have to wait forever. Also, when you're looking for the perfect opportunity to buy it, chances are there's a macro event that takes down Costco, and so all your other stocks are going to be down too. So, what do you sell to buy it? And the third thing is, if Costco falls to 20 times earnings, it's probably because its business model has been disrupted or it's broken, and so it becomes a risky name at that time, and you probably wouldn't touch it. Right? Everybody loved Adobe at 45 times earnings a few years ago. Now, like I see, it's nonstop Twitter on Adobe how terrible the business is, and who wants to buy this piece of crap at 15 times earnings. So that people have very short memories and about multiples and valuations and what they're willing to pay.
I love the answer because I own Walmart, and a lot of our listeners and people in our community, oh, it's too expensive. And then, like Pulak Prasad wrote in his book, Walmart traded at 50 times earnings in 2018, and has compounded since then to this date on 18% on average annually.
Well, that's a cherry picked. I mean, that's the problem is, of course, is those are cherry picked numbers, right? For every Walmart that did amazing, there's a Barnes and Noble that did it, right? Or Pets.com that blew up. So you have to be vigilant. You have to review your companies, but there's only so many great businesses. It's not like that. So many great businesses out there. There's a very small group of them, maybe 15 to 20 names that are just awesome businesses, and they deserve to trade at those multiples. They just deserve to trade at higher multiples. You get what you pay for. You want to buy a Honda, then buy a Honda. You want to own a Ferrari, you got to pay up for it. You want to get a Ferrari on the cheap, it ain't going to happen. And the chances are when you're buying a Ferrari on the cheap, it's a piece of crap or no one wants Ferraris anymore. So that's the way to think about investing. High quality businesses should trade at high quality multiples. You can't be a high quality business trading at a low valuation. It doesn't compute. And if it does, it's either because a macro event has happened or a financial crisis or something has happened, but it's only a temporary issue, and chances are you're too scared to buy it at that time anyways.
But I did a great investment in 2022, in October 2022, when the tech stocks bottomed. I bought Broadcom, and
Okay.
it's been a great story. And it traded at 13 times earnings and has compounded their free cash flow at 20% annually. That's a
Incredible.
behemoth right there. So
Yep.
why didn't the market anticipate this kind of growth in 2022? Is it always the narrative leading the stock prices, or is it something else, Barry?
Yeah, I mean, you could have bought Nvidia at a low valuation too, right? It was all about semiconductors are a cyclical commodity business that tends to overbuild and then boom and then bust. And there's, someone wins and then the next guy comes up, right? Intel's winning, then AMD's winning, then Nvidia's winning. And still, who knows what Broadcom is going to be the ultimate winner in terms of adoption of AI and chip technology. Hard to know, but the market obviously can't tell the future. Because if it did, it wouldn't have let you bought Broadcom at 13 times earnings. So, and it may not have been as good a business as it is today, right? So that's the thing. Since you bought it, it's done incredibly well because it's rode that AI wave, which has been tremendous. And the market, as you know, discounts future cash flows, so people are excited that the future is going to look way better than the past for Broadcom. But I guess in 2022, you had the macro events, you had worries about inflation and Russia-Ukraine war, and all these other things, hot interest rates going up, and that slammed all stocks. And here's the thing, you did a great job, Farouk, by buying the shares at a low price that time, but I would tell you 99% of investors are scared out of their minds to buy stocks when markets have significant pullbacks. They just don't want to invest. They want nothing to do with it.
Yeah, that's an excellent answer. And in in related subject with respect to underperformers, like okay, so underperformers. That's we're not then talking about stocks getting hammered in a wide sell-off, but they are just chugging along, maybe not doing so well. It, maybe it's too early to call it a loser, something you have to cut. Maybe it's just a late bloomer. How do you sort out the good from the bad berries?
Yeah, and maybe not. It's 99% luck. Who knows, right? But
Yeah.
listen, if you want to go swimming, you got to get in the pool. So with investing, you got to put your money to work. And for younger investors who are working and have a long time horizon, I tell them just buy, put it to work every year. You may overpay, you may underpay, but if you're buying great businesses, you're going to do very, very well over the long term. And that's what, and if opportunities pop up, do it. But, I'm not in the business of buying speculations. I like to buy profitable businesses that have a history of raising earnings and growing profits. And I was, quite frankly, we were late to the semiconductor story. We're just buying Taiwan Semi now. Hello, I could have bought it at $80 or $90. Remember when Buffett bought it for a minute and sold it? So at Baskin, I think we will miss a lot of the beginning runs of stocks. I'm never gonna catch the beginning part, but I'm gonna be the last one still holding it, right? So We've owned Microsoft for, I think, now 14 years, Apple for 13 years, Google for 11 years, Constellation for 8 years, Waste Connections for 20 years, Brookfield for 20 years, National Bank for 20 years. I'm never going to buy it right at the beginning, but I'm going to stick around as long as the fundamentals are up and to the right. And I will stick around for the ride, even if there's temporary issues that I know that the company can get through, or if they're in a heavy investment period. That doesn't phase me. What phases me, obviously, is disruption or losing customers, or when they start doing stupid things with financial engineering. Then you got to get out.
So about late bloomers, one of my biggest positions, and I've owned it for 2.5 years, is Alimentation Couche-Tard, and Couche-Tard's valuation is at roughly 17 times earnings, which seems attractive given its M&A track record. And
Yeah.
I've seen some of your comments on BNN and
Hmm.
Bloomberg, and you've discussed on your podcast its 7 and Y bid, and
Yeah.
I totally agree that there was some concerns, but post the 7 and I bid withdrawal, are you factoring a higher cost of capital or deal risk into its valuation right now?
I don't know why the stock is down. Now. I mean, obviously, I can understand why the stock is down, given that the economics of the business haven't delivered in the short term. So this is a perfect example where I don't think there's anything structurally changed with the business. It's just a cyclical time where it has been very tough for convenience stores. They took pricing up big during the pandemic. They had, obviously, there was nowhere to go shopping, so convenience stores were quite active, quite busy. People were at home eating more junk food, smoking, drinking, whatever they're doing. And now the world is, years later, the world is back to where it was. And so some of that growth is being given back. But I don't think it changes the long term economics of what Couche-Tard is trying to do, which is buy convenience stores and improve the economies of scale, given that they're terrific operators. No one can deny that they're terrific operators. No one can deny that they're excellent capital allocators. But they're suffering right now in terms of the same store sales growth in the US being choppy. And so they need to show the market that they can have sustained same store sales growth. Market hates when sales when organic sales go negative, right? Markets do not like declining in top line. So that's the issue that's affecting Couche-Tard. I would have thought after announcing that they're giving up on the 7-Eleven deal, that they're restarting the buyback, they still got oodles and oodles of files of new acquisitions to make, that the market would appreciate that. It did for about 5 minutes, and now I see the stock price is back to where it was when it was trying to bid for 7-Eleven or 7 and I. So I think I still think this is one where it's heads I win, tails I win. I still think they can add lots of value with acquisitions, with share buybacks, and I don't see the economics of the convenience store forever change. I could be wrong. We'll have to see how it plays out. But I'm not paying, like you said, a high valuation for one of the best operators in the world. This has been one of the best performing stocks on the Toronto Stock Exchange, compounding at high 30% rates for a very long period of time. The last few years have obviously been a tough one. And it's not a sexy industry. There's no AI there, admittedly, they're behind the ball in terms of food offerings versus some of its competitors. So that's the challenges it has to rectify. But what gives me a lot of comfort is the four senior guys who started in the business still own a significant amount of shares. They're old guys. They could sell out. They don't need to stick around and have the stress of investing in public markets, but they're sticking around and firm believers, and so that gives me a lot of comfort. I think investors are going to be surprised when the growth picks up in the second half of 2026 or early 2026, and we're counting on a resumption of double-digit earnings growth. So this is an opportunity, kind of like your Broadcom, where I get to buy a company trading around 14 times forward earnings. I think they're going to do 350 a year in 2026, not the current year, but the next year. And I think buybacks will help it a lot. And I think that people would be surprised how many acquisitions they make. So we're sticking with it, but we got a little bit of egg on our face so far on that investment.
Sounds promising. So, from one capital allocator to another, we gotta ask you about Mark Leonard's Constellation Software. It's been an amazing story, an amazing Canadian
Mm-hmm.
compounder. So, how should we think? Like everybody who looks at Constellation says that, oh, it's too big. They buy too small businesses. How can they grow? But what do you know? They keep on growing. So, what do you think is the secret behind the success?
Well, there's a lot of moving parts there. So software is a good business, obviously. We'll see if that changes because of AI and vibe coding. But for now, you've got a customer that once they sign up with you, it's hard for them to leave. They tend to stick with their softwares for at least 5 years. And then there's price escalators, right? There's increased pricing every single year. And of course, you're always contacting your software provider to provide you more upgrades, or there's so for example, we pay for portfolio management software. There's regulatory changes. We have to do this now in terms of record keeping. So our software guys have to make adjustments, and they charge us more for that. We're adding our business is growing, Kenneth. We're adding new employees. Well, I have to pay for more seats, right? And so it's fascinating right now in terms of Constellation's business, how wrong people are about software. I take the view that AI is going to improve the incumbents' distribution of their current software. I take the view that it's going to tremendously help their profit margins and reduce costs internally to produce new software and better upgrades. And I think that a lot of businesses, like, am I going to vibe code a new portfolio management software on our own? And who's going to run that for us? And who's going to check everything? It's not going to happen. It's never going to happen. So I think the pullback on Constellation software or the whole software industry is kind of a poor narrative. It kind of reminds me of, oh no, these guys are an AI loser. Oh, now they're an AI winner. Or the narrative on Amazon when it was trading at $80 is you're never going to get that free cash flow. Now the stock's $220, and you're still probably never going to get that free cash flow. But people have moved on. So there's lots of opportunities, we think, with Constellation. When you're a long-term investor, you're really buying the business operation skills of that company, the capital allocation skills. Those are the only things that matter to long-term investors. What you want to see, of course, is companies that have proper incentives, that have people who have skin in the game. And Constellation has done everything right. What does the future look for Constellation software? I don't think it's going to exist in 10 years. I think they're going to spin off every single one of their businesses. That's what I think the future is. I think you'll be surprised to see what happens. There'll be 10 to 15 companies on the I think Mark Leonard, if he would have, he even admitted it, if he would have started Constellation again, he thinks he screwed up on the incentives. And I think by having smaller spin-offs, it could be, even lead to faster growth. So I don't see Constellation existing in 10 years. I see it spinning off all of its business units to try and get faster growth, and also spinning off other units, whether it's getting into other industries. Who knows what the future brings for it, whether it becomes a high-performing conglomerate owning other assets, whether it even exists. It'll be fascinating. Obviously, the narrative right now is software. You've seen all the software names are getting roughed up. I thought the quarter release from Constellation was a game changer. The fact that the acquisition of the distressed asset Altera is delivering terrific results is testament to how great operators Constellation is. and proves that private equity is not the way to go when you're selling your software firm. If you want the highest buck, maybe it is, but if you want your business to live on, selling the constellation is really the only answer. And so the other thing that, of course, got me excited is the organic growth picked up. If you want to see any cracks, of course, in the business because of AI or people switching, you would see it in the organic growth. And maybe it's too soon, but the fact that growth accelerated is very pleasing to me.
Uh, it's been a great story, amazing. So Alphabet, it's been trading at 20 times PE compared to other tech giants. And when you look at Google Cloud's growth accelerating and YouTube being the second biggest search engine, and looking back at the Google's journey in your portfolio, how has your view on its valuation shifted as it diversified beyond search and touching in the AI space with Gemini and so on?
Mhm. So speaking about valuation, it's really not as important for us. It's more about, can we see future tailwinds? Does it have strong reinvestment of future cash flows? Does it have management with skin in the game? Can we see that people are using more of its products and services in the future or less? That's what we more worry about. We don't start with valuation first. We look at valuation as the last thing, and even at a high multiple, it won't deter us. So I can't tell you whether Google trading at 20 times earnings is a fair price, a low price, undervalued. I feel it's undervalued, but you know what's been trading at a low multiple for quite a long period of time. Google search is the best business the world has ever seen. Absolutely. But now, of course, there is worries about AI impact on its business, and you're seeing it with the adoption of other, chats, ChatGPT and Perplexity and what have you. Google never traded at a valuation that it deserved once it became a mature business. Given the growth rates high, or it's all mostly organic too, right? This is a business that deserve to trade as one of the best businesses in the world at 30 to 40 to 50 times earnings, and it never got there anyways. So and still around the same valuation it was, even though it has lots of potential growth for AI tailwinds. So I'm not too concerned about if it's should trade at 25 times earnings or 30 times earnings, but I know that it's attractively valued. And I think that companies that have such strong durability deserve to trade at high multiples. But technology names, as you know, always trade at a discount because of the fear of disruption. Costco is less likely to be disrupted than, for example, a Google, for example.
Yeah, that's a great point. I haven't thought about it like that. It's actually a great point.
Oh.
And that brings me on to a company that I don't think Baskin owns. I talked with Ernest about it last time he was on our show last year. Have you tried to look at the Dollarama?
Stop asking us about Dollarama. You keep rubbing it in, guys. Unbelievable how stupid we are to not own that name. I had a client, okay, years ago, went public, and she said, I love going to Dollarama. She was an elderly client, and she's a lovely person. And she said, I go there and I find so many cheap things, and I buy for my grandchildren, and they got everything I need. I went into the store and I'm like, this is a junketeria. There's nothing here that there's nothing here that it had no appeal to me. I don't need wrapping paper. I don't need to buy gift bags. I don't need to buy cheap chocolate bars. I eat enough of them anyway. It had nothing of interest to me. And I always thought that the US dollar store companies were better because at least they had all the convenience stuff, a lot more food products that you actually heard of, not really like a Timu store in real life. But I'll give the Dollarama management team credit. They have absolutely nailed it. They got the Canadian consumer absolutely right. Canada retail for many years has been awful, just terrible. We had all these department stores; they've all gone bankrupt, like the Bay and Eaton's and Sears. They're all gone now. We used to have, we have Canadian Tire that kind of is a hardware store, kind of is an automotive store, kind of is a junketeria, but was never one that took off outside Canada. And so I just said, oh my God, here's another Canadian retailer that I don't need, that sells junk, that one day the U.S. guys are going to come in here and take away their market share, and Canadians are going to recognize that they're overpaying for gift bags and party loot bags and all the other crap. But completely wrong, because I didn't recognize the reinvestment of the free cash flows. This is one, though, of course, now the businesses have reached saturation in Canada, right? So completely saturated. Maybe there's some room for growth, but I have a cottage in Prince Edward County. It's a small town in Ontario, maybe a few thousand people. There's two Dollarama stores. They are almost in the same strip mall. I don't know how they both survived. So I think we've overbuilt Dollaramas, to be honest with you, in Canada. I'd be excited to see if they have plans to build out in the U.S., because their concept has worked tremendously. But the U.S. Retail market is littered with concepts that have blown up, right? What's that? Five Below, and that was once a hot stock and blew up, and Ollie's and Big Lots and all these other
Best Buy.
names that or Bed Bath and Beyond. Retail is so tough, and so this is the best retail business aside from Costco and Walmart the world has ever seen. So congrats to the Dollarama team. I was just shocked how they're able to put up those top line numbers each and every year. And when we talked about it, and you talked about it with Ernest, I think the stock was about 120, 130. Now it's $190 Canadian. And it's just a terrific success story. But this is one where I don't think the future growth is going to be as exciting as the past growth. But once again, it could be wrong. I'm not sure I want to invest in Dollarama here when they're buying up stores in Australia. They're starting new concepts in Peru and Mexico. That gets me quite nervous that they may blow their brains out or not really understand the consumers in those countries. But in the meantime, just a terrific, one of the best compounders the Canadian market has ever seen. And I think a lot of old ladies who told their portfolio managers that bought their stock, making us look like fools that we didn't.
Oh yeah, that's a great ending to the episode. So thank you very much, Barry. We're really thankful that you'd like to spend some time with us. You have so much knowledge and really bringing great information to our listeners. And we wish you the best of luck and congratulations on your new job. I should or promotion. I should have said that at the beginning. But we understand why they love you so much.
Thank you so much. And you can follow me on Twitter at Barry Schwartz BW. You can follow go to our new website, baskinwealth.com, and obviously check out our podcast, Long Term Investing with Baskin Wealth, where Ernest and I try weekly to talk about stocks and less about macro, more about long-term investing, and Ernest and I talk all the time. Whether it's on Teams or on the phone or in the office. This is what we love to do. We're very passionate. We're on a little hiatus now because Ernest is on vacation in Europe with his family, but we'll be back with lots of great episodes going forward, and I really appreciate you guys having me on your amazing podcast that's growing so quickly, and congrats to you guys. And I'll say that I knew you when you only had a few hundred listeners, and now you got thousands and thousands, and you're going to be the next podcast platform to reach the skies. And so I can just say I was on these guys from Norway. They're just great investors, and they know what they're talking about. So hopefully one day I'll come visit you in Norway.
You're
What's what?
always welcome here, Barry. You really deserve the praise, and we want you to send our regards to Ernest as well.
I will. So with that, I guess we'll see you later. Thank you so much for having me.